What's up, HyperFast Nation? On this episode of the HyperFast Wealth Show, I talked with a special guest who is a multifamily investor. She has $100 million fund and offers syndications into singular assets as well. So we talked about the difference of that, as well as what you should look for in deal sponsors. Welcome to the show, Veena Jetti. All right, welcome to the show today, Veena. How are you doing?
I'm good, thank you. I'm so excited to be here.
Yeah, I'm excited too. I know you're on a lot of podcasts, so I'm glad you're able to squeeze this one in.
I am. I like to talk a lot, so it's a good fit.
Well, I'm excited to talk about your funds, your syndications, how you help people connect with really great multifamily real estate projects. Before we do that, though, why don't you give people a quick bio and just a little information about how you got to where you are today?
Yeah, so like you said, I'm Veena Jetti. My company's name is called Vive Funds. I'm based out of Dallas, Texas. We have a little under 600 million in our portfolio currently across Texas, Florida, and Georgia. We're large multifamily owners and operators, so we don't look at anything under 200 units at this point. We really focus on that value add space where there's a way for us to not just optimize the efficiencies on the asset, but also to renovate and force some appreciation on the asset as well. As far as how I got started, so I took a little bit of a shortcut because my mom is a very successful real estate investor. My parents retired early from their real estate portfolio. And so I kind of had a really good foundation. I grew up in this world. Graduated from the University of Illinois at Chicago when I was 20 with my degree in finance. Thought I was going to do something revolutionary, not work for the family business. And I went into corporate real estate. And so I left the corporate world several years ago, almost a decade ago now, and started my own shop. And that's how I'm here now.
Awesome. Well, it's always good to have, I think, exposure early on, which seems like you did through your family. How was it when you broke out and set up your own shop? Were you nervous, scared, or already had a lot of contacts, investors lined up, or deals lined up?
No, it was terrifying. Basically, once you take in investor dollars, you just never sleep again because now you have a responsibility to someone else's money. So when I left corporate America, I actually started by investing for myself. So our family just invested alone. I had a lot of friends and people that were just in our social circles say, "Oh, wait, how are you doing this? Can you teach me how to do this like on the weekends?" And I'm like, "No, you work 100 hours a week at your busy job and this takes me 100 hours a week to do. So no." And then it turned into, okay, well, why don't you just take this check from me, put your investment out, and then I'll just co-invest with you. And I was like, okay, maybe, but I didn't really know what the SEC rules were. I didn't know what the structure should have been. So I reached out to our SEC attorney. He said, "Yep, here's how we structure," got us all papered up correctly. And that's really how I started taking capital. So it was not planned when I left the corporate world to take in investor capital.
So you just got good at finding deals and executing, and other people saw that and kind of wanted to go along for the ride.
Yeah, I mean, it's really what happened, because for me, the challenge even today is not in capital. The challenge is finding those deals that you want to put your name on and that investors can invest in confidently.
And I heard you say earlier in the intro you're doing some sort of value add. So are you seems like the typical multifamily syndication right now is like they're buying deals at like 4 caps, even lower on some I've heard. I'm guessing if you're doing some type of value add, are you able to push a little higher than that, or what's your typical deal?
I wish. At this point, because we look at 200 units plus, we're really going after institutional quality assets. So right now, the latest asset that we're putting into our portfolio is a 2011 build. It's barely 10 years old. It's 296 units. It's an $81 million purchase. So it's a sizable asset, but it's an institutional quality asset. And so cap rates on those types of assets, I wish they were in the 4% range. Like that would be great at this point, but we're in the hottest market we've pretty much ever been in. And so any asset that we're going into today, we're seeing cap rates compress like crazy. We're not seeing 5%. So we're going into those like B++ assets in A locations. Now, if you're going into like a B- asset or a C asset, then yeah, I would assume you're going to see closer to like 5, maybe somewhere between 5 and 6% on the cap.
What kind of markets are you in? I know you mentioned Florida, Georgia, Texas, I think. So are you in more of the urban areas if you're in these kind of B+ cap rates? Or
post-COVID, we've seen really an influx into more suburban areas. People want nicer amenities. They want more room. They are home with their children all day. So they want to be able to have multiple bedrooms, or they're working from home. So they want to have another bedroom for an office. And that's really what we're seeing in our tenant base too. So with that, we're primarily right now, we've been acquiring in Atlanta like crazy, the Atlanta suburbs like crazy. Not by design, but the last 3 assets that we've gotten have all been in that $80 million range in Atlanta over the last year post-COVID. And our fund, so Rev Fund, is set up to do offerings in Texas, Florida, Georgia, North Carolina, South Carolina, and Arizona.
That's one fund. People invest in that, and then that fund then goes and acquires multiple projects.
Yeah, so theoretically it works like that. In practicality, the way it works is, so it's a $100 million fund, and we source the asset first, and then we accept investments into the fund. So the fund is designed to be a 5 to 7 year investment with 5 to 7 assets in the fund by completion date or by complete investment.
Hold that thought for a second. Do you struggle with how to scale your real estate business without trading your most valuable asset, your time, for money? If so, Carrie and I want to help you. Since March of 2020, we have doubled our sales and tripled our profit. And we want to help you grow your real estate business in a smart way at the HyperFast Summit in Boca Raton, Florida on February 1st and 2nd, 2022. We're bringing together top real estate leaders to help agents from all over the world. Go to hfasummit.com for tickets. Again, that's hfasummit.com for tickets. So if you find a new asset to go put in the fund, and you need 10 million of equity to buy that asset, you'll go out and raise an additional 10 and then kind of repeat the process. Is that my understanding?
Yeah. And so not all of it comes through Rev Fund. So we usually do a direct offering on the asset itself. So let's say we're buying 123 Main Street, and to your example, we need 10 million of equity. We might put 5 million of equity through Rev Fund and then 5 million directly into the asset. So it's really, Rev Fund was born as an answer to the investors that were wanting to have more of a set it and forget it model, more diversification across their investment, someone who could plan every quarter to add 50,000 or 25,000 or whatever that looks like for them. They wanted to be able to plan that on a little bit more regular basis, which is why Rev Fund was born.
So then when a new asset comes up, your investors could go directly into that, or they could go to this fund, which is diversified into more projects. And what's the difference in like the kind of return structure or to investors for each of those models?
Yeah, so to investors, there's no difference, mainly because we underwrite to the same metrics, whether Rev is the investor into the asset or you're invested directly into the asset. either way, we need to hit our projected returns. So if it doesn't underwrite to the metrics of the fund, then we don't offer it in a direct offering either.
So is it a preferred, either way, is it a preferred return plus some waterfall kind of?
Yeah, so we have two investor classes, either in our direct or our Rev Fund, that primarily are where investors come, and those are 8% on Class A shares with no additional revenue share after that. So it's just a straight 8% pref. It's more of my investors that are closer to retirement, maybe want just more of a coupon rate. That's what they go into, or they blend. And then my Class B shares are a 6% preferred return with a 70-30 split. And then typically we'll have a hurdle at around 12% IRR. Then it goes to 50-50 between the sponsor and the LP.
What do most people like better, the single asset model or the fund model? Like what's your kind of split between that?
Yeah, it's funny that you asked me that because I wasn't sure what the answer was going to be. And something interesting happened that I did not anticipate. So what I had a lot of was investors that invested into Rev, and then they saw an asset in Rev Fund that was coming into Rev Fund, and they're like, oh, but I really love that asset because I went to college there, or my cousin lives there, or whatever. And so then they invest into both. So they'll go into Rev Fund, and let's say they put like $100,000 there. Then they'll say, but I also want to be directly in the asset, so that they're increasing their position in the single asset. So it's kind of the blend of both for them. So I've seen a lot more of that. I didn't even think anyone was going to do that before we put that offering out. And then on my investors, I see more investors coming into the direct asset. And I think a part of that is, my investors write fairly sizable checks and they want to handpick their investments. Whereas my JV partner, her investors come more through Rev Fund because they like to allocate those large checks on a more regular basis. They want to just put it in and they like the diversification. So it's really investor dependent. We see both, but I surprisingly saw people coming into both on the same deal.
Yeah, I think people like being able to see like one project or asset and knowing that it's tied just to that. You would think they would go with the diversified model probably more than they end up doing, but
yeah, no, that's true. And it's the weird thing is I think it's because in Rev, it's like a theoretical asset that's going in there, right? It's not defined which assets, or you only know the assets that are already in the fund, but you don't know what's going to come in the future. So I think it's just interesting, and it's been weird to kind of see the movement, and we're seeing a lot of influx into multifamily especially, but real estate in general, because it's an inflationary hedge. We're seeing what's happening in the stock markets. We're seeing inflation happen. We know that housing is this is such a hot market. It's so hard to buy assets. So we're seeing a big influx into the multifamily space, which is historically a very stable asset class.
Does the prices you have to pay, to get assets, does it make you nervous at all, or do you think we're in such an inflationary environment that rents are going to go up, which of course drives up the values?
Yeah, I mean, it's obviously something we do a lot of analysis on. We don't just go out and pay a price. It doesn't make me nervous in the sense that we're pretty conservative in our underwriting. So as an example, we have a deal that has 100% interior renovations available. Nothing's been done on it. And we underwrote it to a $300 post-renovation premium. But on a weighted average, these units are $548 below the nearest comps. A lot would have to go wrong in order for me to really miss those projections. And so we underwrite to where we're going in. And when we underwrite the deal and we're acquiring the deal, we don't go above our top limit. We have a hard stop and we stop, we walk away. So we're willing to wait and not go into any assets if it means waiting for the right asset. So we don't try to force it. We're not fee driven in that way. This is not going to put food on my table or not, if we do a deal or not. So it's a little bit different for us. So Yes, I am. I am always cost conscious. We're also always looking at replacement costs. So if there's something I have to exit at a replacement cost if the replacement cost is much lower, then that's a problem, because who's going to buy an asset? And it might happen, but it's just a risk to take. If you're in today's market, you'll probably have someone who will buy it. So it really depends on what you're looking at, who you're exiting to. We have very clear exit plans on all of our assets.
Hey, hold that thought for a minute. Are you a real estate agent in the DMV area, or thinking about becoming a real estate agent in the DMV area? Why not join the highest selling team in the DMV? The Carrie Scholl team is hiring more agents. We have the best training systems, the best culture, and the best environment to get you to the next level, whether that's starting out and getting to 6 figures, or getting from 6 figures to 250, or to $500,000, or even beyond. Go to carrieschollcareers.com. Again, that's carrieschollcareers.com.
And what is your value add or operational strategy when you buy an existing asset? You know, I think the last one you mentioned, you said was 2011. So I assume it was fairly rented up, but what do you and your team do, you know, once you buy an asset to make it more profitable?
Yeah, so we buy only stabilized assets at this point. So we're not new dev where we have a lease up period. So our investors see cash flow from day one of closing, and we actually pay out within 90 days post close. We also pay out on a monthly basis because I'm a glutton for punishment. So we add extra work, we pay out every month, but our investors like it, and we want to make sure they're taken care of first. But from a value add perspective, there's a lot of ways for us to go in and add value to any asset that we acquire. So on a 2011 build, for example, 100% of the units are classic units. The area has $100,000 median income and $300,000 to $500,000 homes today in that market. So what we're going to go in and do, we've underwritten for over $11,000 per unit, and we're going to go in and we're going to renovate it, and we're going to bring it up to market, because once we bring it up to market by adding, so there's laminate right now, we're going to move it to granite. We're going to replace the flooring and put in some nicer flooring. We're going to upgrade lighting, stainless steel, all that stuff, because that tenant base really demands it, and they'll be willing to pay for it because the asset is really nice and it's a stable asset. And so when we go in there, we add that value to it. We start pushing rents, and we're seeing it on other assets, especially in that submarket where tenants are paying an additional $300, $400, $500, $600. And that's way above where we even assume or underwrite the deal.
How do you do the renovations? Do you kind of do them during as tenants turn over and leave, or?
Yeah, so typically what we'll do is we will renovate the units when we get a notice to vacate the unit. We'll go in, we'll renovate it, and we'll bring it back online at a higher price with new pictures, and make it look polished and pretty. With our model units, show what the renovated interiors look like. But we also, in this market, we've been seeing a lot of tenants that are just paying the pricing increase without renovating it. So we're not expending the CapEx dollars, and we're getting the premium that we wanted. So it's always great.
Interesting. Well, it seems like this trend is going to continue for a while. I don't know anything that's gotten cheaper over the last year or two, any really product or service. So, yeah, it's kind of fascinating though that you'll get some people that'll just pay more without the renovations.
Yeah, no, that definitely is happening, and it's because a lot of times they don't want to move. They don't want to be inconvenienced. Maybe rental prices haven't increased in, a year or 2 years. And there's really, the markets that we're in have just such a huge demand and not enough supply. There's not enough units coming online. There's not enough building permits. So this is really a supply and demand issue that's driving this, along with, the inflationary effects that we're seeing in the economy. So I don't think that this is a bubble per se. It's not like 2007, 2008, 2009, where we saw that bubble burst due to, subpar lending practices. This is really just a supply and demand issue, not anything else.
What do you think, if people are out there listening and I know we're throwing around a lot of terms and whatnot, but they're, let's say people are considering investing in something like this, whether it's with you or someone else, like, what do you think as the investor, the important things to look for in the deal, the operator, like how do you go about making sure you're making a good investment?
Oh gosh, yeah, there is a lot of due diligence that I think investors should put into investing in these types of deals, because the reality of it is the barrier to entry is very low. So there are a lot of operators in this space that I see underwriting, and it kind of scares me a little because, to your point, they're paying for assets that don't really have a great business plan or strategy behind them. So you definitely want to vet your sponsor pretty carefully. You want to know who you're investing with. You want to make sure they're following SEC rules. So you can, there's a website called edgar.gov. You can go there, you can see if your sponsor is registered with the SEC there on their offering. Make sure you ask them for the name that they're registered under, because it may not be the exact name. Like mine wouldn't be under Vive Funds. We create entities for our projects. So there's a lot of different ways you can vet sponsors, but talking to them, interviewing them, understanding their strategy, asking whatever questions you have. And then also I ask sponsors before I invest with them how much they have co-invested into the deal as well.
Awesome. Well, those are, I think, all great questions to ask and things to look into. Before we wrap up, I always like to end with a HyperFast round, if you're ready for some rapid fire questions and answers.
Okay, let's do it.
What's your biggest piece of advice to a new real estate investor?
Oh, that one's so easy. Get started right away. Don't wait for the perfect time. It's never going to come. There's always going to be a reason why you can't. So start figuring out why you can and get started.
All right. What's a mistake that you see successful real estate investors make?
Okay. Wow. This is supposed to be fast, right? Because I have a lot of these. No, I think that the biggest mistake in today's market that I'm seeing is very aggressive assumptions on underwriting and where you actually can perform on your deal. And if you do that and you don't deliver for your investors aren't going to be happy. And this is a very short-sighted move to make, in my opinion. So don't be fee driven. Make sure you're investing with the long-term picture in mind.
What's the biggest challenge you've ever had in business, and how did you overcome it?
Oh, I've had lots of big challenges in business. I think that one of the big challenges for me was in rolling out Vive Funds, because I am the decision-making partner in that company. So the buck stops with me at the end of the day. And I think that was very intimidating, but I'm glad I did, because I've realized that in being able to control the deals myself and being able to decide what we do, where we do it, when we do it, it's actually given me an opportunity to grow and perform better than I've ever performed for investors.
What are your favorite investments outside of real estate, if you have any?
Yeah, no, I do. So, I kind of like jumped a little bit on the cryptocurrency train, just a teeny little toe in the water. And then I invest passively into other syndications that, like I invested in a movie production studio, the real estate and the business of it. It's done phenomenally. I invested into like an assisted living facility. I've made some tech startup investments. So I like those types of things. They've been fun to play with.
Awesome. Last one. Where do you see yourself 10 years from now?
Oh gosh. If you asked me this 10 years ago, I did not see myself here. So it's hard for me to say, but where I really want to be is I want to step out of maybe the day-to-day activity of the company, have a CEO in place or a COO in place, and really focus on the strategy and the investor relations and the investor experience of my company. That's really what I enjoy the most. And so I want to make sure that I'm giving my full attention there, and building out my team appropriately. And then also being able to take some more time with my family and my kids.
All right. Well, thank you so much, Veena. This has been great. If people are listening out there and want to learn more about your funds or any particular assets they might want to invest in or just connect, how should they do that?
Yeah, so you can go to my website. It's Vive Funds, ViveFunds.com. And I have an investor portal there. You can see our offerings if there are any open at that time. You can schedule a call with me there, or you can find me on social media. I'm pretty much on like everything as Veena Jetti, VeenaJetti. I'm on like, Instagram, Clubhouse, Facebook, all of the things. So Twitter, you can find me pretty much anywhere on social media under my name.
Awesome. Well, thank you so much for being on the show. If you guys are listening out there and want to learn more, you go to, it's vivefunds.com. Is that correct?
Vivefunds.com, correct.
Go to vivefunds.com. And Veena, thank you so much for being on the show. And to all our listeners and viewers out there, thank you. I'll see you next time.
Thank you for tuning in to this episode of the HyperFast Show. Subscribe to us if you want to make sure you get the latest and greatest HyperFast shows. And remember, we love reviews. Reviews help us bring better and better guests and improve our shows. So give us the good, the bad, and the ugly. We hope you enjoyed the show, and we will see you next time.
Hey guys, thanks for sticking around to the end. I hope you enjoyed that video, and if you want to see more, click right here. And if you want 100 real estate tips from my best-selling book, click right here to download them instantly. And if you're new to this channel, click below to subscribe and turn on post notifications so you don't miss out. And leave some comments about what you think on the videos.